Someone You Should Know. A program about people you know and even more that you don't. Hosted by Stuart Sachs, veteran, husband, father, and grandfather. Now, here's your host, Stuart Sachs.
Welcome to another edition of Someone You Should Know. Glad to have you with us again. And as always, we are brought to you by DFW Networking Diva, my good friend Christine Dean. If you have any questions about marketing, about websites, about how to grow your business visually via the internet and social media, that's the lady to call. Christine Dean, dfwdiva.com. Go online, and you can even make an appointment to talk to her free for a free consultation. Call her. She'll help you out with your business. She's a great, great girl. And my guest on the show this morning also knows Christine Dean and interacts with her through the Alan McKinney NetWeavers. My good friend John Snell is with us. Good morning, John.
Hey, good morning, Stuart. Great to be with you today.
Glad to have you here. We're gonna spend some time talking about mortgages, and normally it's a pretty dry subject to a lot of people. But boy, lately, I mean, mortgaging, refinancing, first-time buyers. Just was talking to our producer Mark, but before the show started about homes in the North Texas area, especially. They go on the market one day, they're gone the next.
Oh, absolutely. And what we're seeing is multiple offers, bidding wars. We saw that a few years ago, but it's really come back now, probably stronger than it was before. I have a couple of clients that closed on their new home last week, and they to win the bid, they offered $10,000 over the asking price, which interesting. It wasn't like a real high priced home, but that's a lot of money to pay over the asking price, and we're seeing more than that on the higher priced homes.
Yeah, there were some bidding wars going on it's almost 7 years now that when we moved to North Texas back in 2013, there was a lot of that going on. Our real estate agent said, you see a house, whatever the list is, pay that list or throw something else in. And I had never heard of that. I mean, it was always like bargaining for a used car. Whatever the price was, you knew you'd probably get it for 10%, 20% less than the asking price. But now we had a neighbor around the corner, same thing that you just said, that somebody walked in and saw it, made a bid. Somebody else walked in and said, I'll give you 10,000 more for it. And they got it immediately. I mean, sold in 24 hours. It was, which we normally would think is unheard of, but it's just that market. What do you attribute that to? Is it got any relationship to this COVID thing that people are finally saying, okay, I think it's safe to put our house on the market rather than just refinancing or remodeling?
Well, I think there may be an aspect of that's COVID related. I think part of it is that there's a lack of inventory, and whether people are concerned about buying another house right now or just staying put, the people that are typically going to move up and sell their homes, buy another one, are not out there doing that yet. So it kind of clogs up the market for those first-time home buyers and so forth. So there's definitely a COVID aspect to it, but it's mainly economics. There's a lack of inventory right now. So everybody, when there's a lack of inventory, the prices can be driven up, and that's what's happening.
Well, and also we're still in a very high growth area. So as people are moving into the North Texas area, as I say, those few homes that are on the market get grabbed up rather quickly. Now, are you finding on the other side of the coin, is it becoming more difficult for other people to get into the market as far as getting their homes ready to put on the market because they see that they're selling for high prices?
Well, that's another good aspect of the situation. A lot of people don't want to sell their home because then they fear they are going to have troubles finding the next home. So that contributes to it as well. I've helped people avoid that by qualifying them to buy the next home before they sell their current home. That takes a lot of the pressure off of that. But it's really, most sellers will not take a contingency offer that you would have your home sold first before accepting the offer that you would buy theirs. So it's crazy, Stuart. It's crazy out there.
And the two areas that I want to really get into a little more, and that is, you mentioned the word qualifying, and tell our audience a little bit about what are some of the points that are part of that pre-qualifying road that they really should take advantage of before they even start looking for a house.
Absolutely. So you have to be pre-approved, not pre-qualified. There's a distinction there, but every client that comes to me, I pre-approve them, which means I'm going to verify their income. I'm going to pull their credit. I'm going to verify their money that they have to buy the home, as opposed to a pre-qualification where you're just being told that information as opposed to verifying it. So it's absolutely imperative now, especially to be pre-approved before you're out there shopping. And most realtors will not put you in their car unless you have a pre-approval letter from your lender.
Really?
Mm-hmm.
And the various forms of lending, still FHA, VA, conventional, and all. Are there any advantages of somebody looking one way or the other?
Well, typically, I try and place people in conventional loans if possible. The down payment requirement is 5%. There have been some 3% down loan programs on conventional loans, but usually 5% is the magic number for the down payment. FHA loans, the down payment is 3.5%. But the main difference is going to be if somebody has less than stellar credit, then more likely they'll have a better deal using FHA financing. If the credit is decent to excellent, the conventional loan is going to be far superior. And one of the big differences between FHA and conventional is that the mortgage insurance on an FHA loan is more expensive and it never goes away during the life of that loan. Whereas with a conventional loan, if you put less than 20% down, you're still paying mortgage insurance or the PMI, but it will drop off after you pay your loan balance down to a certain level. So it's really kind of credit driven and down payment driven. If somebody just doesn't have the cash and their credit's not great, then I'll probably put them in an FHA loan. But other than that, I want them to do conventional. It's in their best interest.
Well, after what you've just said, the main point I think that we can share with our audience is that to call on a professional like John, because if you got questions, I know, and I've heard you in some of our networking meetings, and I'll talk about the fact that if you've got questions, throw them at you, because you're the juggler. You're the one that takes all the pieces and puts them together in order to make it work. Just briefly, VA loans. Am I correct? Is if someone has a home that they've taken out with a VA loan and they sell that property, they can use that VA loan again?
Absolutely, Stuart. As long as as long as that VA loan is not assumed by the person buying the home, then that eligibility gets released back to the veteran, and they can use their VA eligibility again. One issue: VA loans are great loans, especially the first time you use it, but the VA funding fee, which is their form of mortgage insurance, is greater the second time, third time you use a VA financing, unless you're putting a significant amount of money down. So, so you'd be better off when you sell your home going with a conventional loan the next time. But it's always something that I will go over those options with my clients and show them what is better for them.
Well, I feel better having heard you said that, because that's what I did. I used my VA loan for my first home, and then I went conventionally after that. It was my benefit. So you know, I'm a young guy. I just got engaged. My young wife and I, we want to start a family, and we're looking for a home. You say the first thing you do is not to get pre-qualified, but get pre-approved. So
Correct.
I'm working. My fiance is not working. What can I realistically look at? You know, in a starter home, is it driven by area? Am I better off looking at pre-existing homes? Am I better off looking into new builds in new communities? What does that first time buyer look for?
Well, first I would say you want to look at the geographic area where you want to live. And so in addition to that, you want to look at how much your income is and how much can you afford. And so the combination of those two things will tell you what certain areas you might want to be looking at, and whether that area may be predominantly pre-owned homes or maybe new construction. What you'll find, Stuart, is the farther you move out from the central business district in any metropolitan area, the real estate is cheaper, the land is cheaper, and so the home prices are going to be lower. And that's why you start to see movement farther out into the suburbs, because a home price, same home in Plano might be $750,000, in Frisco it might be $500,000, and then in Prosper 400, you know, something like that. So especially for first-time home buyers, a lot of times, you know, moving a little bit further out gives you much more affordability.
So the trade-off really becomes: are you willing to invest additional time to get to and from work, because it's a little bit further drive in order to do that? Which the other side of the coin, though, is if somebody is working, say in downtown Dallas or in downtown Frisco or downtown Plano, that may be looking into a townhouse or a condo or something that's centrally located, it would be worth looking into, as long as you have the funds to pre-qualify for that.
Correct.
Pre-approved.
Yes, sir. Now, I will say one thing about condominiums. They are a strange beast. They've been around really since probably the early to mid 80s. A lot of the real estate developers were buying old apartment complexes, converting them into condos and reselling them. They really weren't a true condominium. They were just dressed up to look like one. And so when the real estate market busted, then condos got a real bad reputation. So even to this day, there's kind of a two-step approval process. Not only do you have to be approved as a borrower, but the condo property has to be approved as well. And so there's some strict guidelines for that. And so anybody I know that is out looking for condos, I'd give them the criteria that they should be looking at. And if the property doesn't meet that criteria, they're going to have a hard time getting approved to buy it.
Very, very interesting. Well, I think at this point, what we should do is make our audience aware of how they can reach you. So if they have questions, they can reach you by email. They can also reach you by phone. And Mark just put it up on the screen, so folks jot it down or take your phone out and take a picture of the screen right now, so you have the information. Because it doesn't necessarily mean that you're looking for a house right now, because it may be that 6 months or a year from now that you may decide you want to put your home on the market and you want to get some questions answered. John's got the answers. And all, I know that. I've interacted with him enough over the last couple of years now that I know that you want to ask somebody who has your best interests at heart. And that's a very important thing. That's why I threw out that example of a young couple. Young people can be very impressionable. You know, they know that maybe they can only afford that VW, but they want the Cadillac. Mm-hmm. So, you know, they're always there. That's another drawback, I think, sometimes at looking at new properties, because they say, oh, it's a brand new subdivision, so buy in on the ground floor because the home will appreciate in value even more. Problem is, sometimes getting in is going to bust your budget to the point where you may not be able to be there long enough to take advantage of that growth. Right. You know, that's why you have always said, and I concur, you don't want to overspend yourself. Always look at what you can afford, and that's why that approval process is important, because then it says to you, based on your finances, your income flow, projected as well as accurate right now, this is about the price range you should be looking at. Mm-hmm. And then, like you said, that may be the difference between looking in Plano or Frisco or Salina or Sherman or Oklahoma.
Let me just say one thing about the new construction, Stuart. The homes are beautiful. I've built 2 new homes in my life, and but if you're going to be buying in a new construction neighborhood, you really want to make a mental commitment to staying there 10 years, because that subdivision is going to take a long time to mature. And when that's the situation, there can be some volatility in home prices, especially if the market turns down. You may have trouble selling it because the builders are much better at dropping their prices to compete. And then if somebody has the choice between your home that's 3 years old and the builder's home, which is brand new, for the same price, they're going to go with the builder, not your home. So once your neighborhood has been established and is mature, that volatility kind of goes away. But anytime you're looking at new construction, you really want to kind of look at it with a longer term plan than in an area that is mature, like Plano is pretty much built out, for example.
Well, you know, and I think you're absolutely right. You better commit yourself to a 10-year plan. And what does that mean for young people that are starting out? That means 1, 2, maybe 3 children within 10 years. Does the community have elementary and middle schools and high schools on the books? What facilities and amenities are there going to be for you and your growing family during that 10-year period? Yeah. And also, when we were talking about condos, I have always been a little leery of condos myself, because you may get yourself a fairly decent condo at a payment that you like, but you got to watch out for the monthly homeowners HOA fees.
Yeah.
Because while your monthly mortgage payment may stay the same through the life of your loan, that isn't true for the HOA fees.
Right. I have a client a few years ago that they got a special assessment on their condo. They had to replace the roof of the condo. That's not part of the regular operating budget. So they came back to all the owners and said, we're going to collect another couple $100 a month from you guys. And, that can stretch your budget. Stress your budget. Sorry.
Yeah, and then you're faced with, well, if I can't afford it, then I have to put my condo on the market. And now I'm moving. All right. Now I want to throw another subject out, because I know that you're passionate about it, and it's very, very realistic. We said earlier, okay, young couple buying their first home, make a commitment to live there for 10 years and all, but after 3 or 4 years, the marriage goes sour. And you're faced with, now what do I do? We're going to have to sell the property or whatever, or how do I get out of this marriage, and also this commercial commitment that is probably the largest purchase that you ever going to have. I know that you specialize in working with divorced couples in trying to help them through these situations. I want you to share with the audience a little bit about, not that we're promoting divorce, but
Right.
We live in a realistic society where our divorce rate is nearly 50%. So it's a realistic thing to talk about. And John has his facts together about what you can do and what you should do. So the floor is yours. Okay.
Well, this is a niche in my lending business that I'm very passionate about, Stuart. The reality is that roughly 50% of couples are going to get divorced. And over the years, I have just seen such devastation when these people come back to me later and try and qualify for a home. And so I don't know, 10, 15 years ago, I started focusing on helping people going through divorce. And the way it kind of came about was I had a divorce attorney approach me. And back when our licensing requirements were only through the state of Texas, it was a little bit easier for an attorney to get his loan officer license. So he said, John, I do tons of divorces. I want to help them get the divorce process done. And also almost every single one of them, there's going to be a refinance involved where one of the spouses wants to keep the house. And so I want to kind of do this as a one-stop shop for people. And I need somebody to sponsor me to do that. And so I became his sponsor at that time. And we worked for many years together under that relationship. Although the very first transaction we did, I offered him my same really generous commission split that I gave to all my other loan originators. And then, which was at that time 70-30. And but I counted on all my folks to do all the work. I'm just kind of supervising, and that was a good split at that time. And so I offered it to him. The very first transaction we worked on together, I ended up doing all the work. And I went back to him and said, I don't like changing the deal, but I'm going to change the deal. And so I'll give you 30, I'll keep 70, but I'll do all the work. And he was very, very happy with that arrangement, as it turns out, because he didn't realize how much effort goes
into 30% for doing nothing.
Yeah. Well, basically handing it off the file, So we worked very closely for many years. That was kind of my introduction to the family law business. And since that time, I've worked very, very hard to not only understand the attorney's world very well. I I know many attorneys, judges in town, and I understand how their process works, which is a real advantage to the divorcing, refinancing client. But I also understand and have built my practice on understanding the specific mortgage guidelines that are related to divorce. And most originators do not know that. So I'm very passionate about helping people. And typically there's two things that are going to come into play. One party may want to keep the house, and they're going to be required to refinance it to get the other party's name off of the mortgage, and also to buy out their equity in the home. And then the other party has got to move somewhere. So I help a lot of those people that are leaving the marital residence to decide, am I able to qualify to buy a home right now, or should I rent for a little while, let the finances kind of stabilize a little bit, which that's the case for a lot of people. But we help put together the plan, whether they buy now or buy later. And that's really kind of the two types of people I'm going to be helping in the divorce process.
We did put up on the screen, you also have another website, texasdivorcelender.com. So if that is a question for anybody that's listening, or maybe a family member of somebody in the audience that may be going through that situation and needs to have some questions answered, go to the website. You'll find some information there, and then you can get in touch with John. It's not an issue that anybody wants to think about, but it's a reality in our society today that sometimes you just have to know what to do before you get the whammy, before it hits. No, that's part of the process that unfortunately in a divorce, you have to decide what is in the best interest for the two people. And if there's a family involved, assets involved, what are you going to do and how best to do it in an amicable way?
Yeah. And Stuart, I'll say on top of that, when you're thinking about going through a divorce, there's a lot of issues you got to consider. And once you get connected with an attorney, and if anybody needs a great divorce attorney, I know a lot of them, I'm happy to make a referral. But thinking about what happens to the house and where am I going to live? And those are some of the issues that I help people work on. And typically the best way to do this is to look at it before you start the process, to kind of understand what your options are. And that way, when you go see your attorney, you've already got the real estate plan sort of put in place. And then the attorney can focus on the child issues, the division of your assets and so forth, and not have to worry as much about the real estate part.
So it really is not a foregone conclusion that if you're going to go through a divorce, one of the things you do, you just sell the house and you split the asset 50-50. Mm-hmm. Because unfortunately, if the husband was the breadwinner and the wife was the housekeeper, if she gets half of that money, she's still got to go out and get an apartment. She's going to have to get employment, and she's got to start her life all over. If he's already got a profession, it may be a little bit easier for him to go out and get another house and continue on with his life. So there's lots of balls to juggle in that situation.
Yeah, there are some really strategic things that a stay-at-home mom can do to put her in a position to qualify for a mortgage. But again, it's planning. It's starting as early as possible, and so I do consult with a lot of stay-at-home moms.
Well, I don't really want us to dwell too much on divorce, but from the standpoint of it is a reality. And again, that if you those listening to the show, and let me also ask you, John, this show basically is in the DFW area. Everybody knows that we're in northern Texas, but we've got people that are watching this show all over the country. Will you field questions from people anywhere in the country that have questions about, maybe what should I do, or what can I do, or are you just limited to the Texas market?
Well, I'm happy to answer any questions from anybody all over the country. I am licensed in Texas only. So if it's outside of Texas, I would be happy to give a good lender referral to them in other states. If it's a divorce related question, I'm part of a group called the Divorce Lending Association, and they provide certifications. I have a certified divorce lending professional designation, so I can hook somebody up in other states with another CDLP professional. And if they're not going through divorce, if they just need a lender, I've got a good network across the country for that.
Excellent. Again, during the show, Mark will point up the website, the address, the phone number, and everything. Jot it down, because John, maybe if you don't need him today, that doesn't necessarily mean 6 months, a year, or 5 years from now you may need his expertise. Another topic that I want to talk to you about is refi. We have seen over the last so many years the interest rates on home mortgage loans go up and down like a rubber ball. Are they in good shape right now? Is now a good time if somebody says, I want to maybe turn some of the equity in my home into some cash and maybe refinance? Now a good time? Where are the rates? Where have they been? Where are they going?
Well, I would say it's still a good time, but there are many reasons why people would want to consider refinancing. The first and obvious one is to lower your rate and lower your payment. And rates have actually gone up a little bit from their bottom, which would have been probably the beginning of this year. And they've gone up quite a lot from there, but they're maybe, hopefully, fingers crossed, kind of recovering a little bit on that. So whereas we were maybe at a 2.5% rate on 30-year loans, to now 3, maybe 3.125%, still all-time record lows. If you look at decade by decade,
right.
These are phenomenal rates still. They're just not as great as they were a few months ago. So I would tell anybody who's on the fence to get off the fence and get it done. I think I've told people a while back that the rates really came down, a lot of it due to COVID. And once we start to see the end for COVID, I think we'll see the economy pick up, the rates will go back up into more normal range. So they've been below normal, but I still think the rates will stay below 4%. And so anybody who's looking to lower their payment, then obviously get off the fence. For somebody that needs to pull cash out of their equity in the home, that is a different scenario. Maybe the rate isn't quite as important as getting the cash out. So if you had $50,000 of credit card debt that you're paying 20% on, it would probably be worth it to take a little bit higher rate, say 3.5 or 4 even, to wipe out all that credit card debt. So everybody has their own specific circumstances, and part of my service I provide is we'll review all that, and I'll present options to people to show them, what it would look like before we even start the process. And then if it looks good to them, then we go forward with it and get it done. I tell people from time to time, no, I don't think you should refinance. You've got a good deal already and it doesn't make sense. But for people that does make sense, I tell them, let's go.
Yeah, I was just going to say, you said that, okay, if it's 3.5, maybe even closer to 4%. But if somebody's sitting with a 4.25% mortgage, it probably isn't. Is it worth their while to look into refinancing, or is it more for somebody that's got a 6 or 7 or 8% loan? That would be the candidate to look for the refi.
Well, obviously, those people should have done it a long time ago. But anybody that is, say, 4.25 and above should be looking at it. I'm not saying they should do it, but at least run the numbers. And a lot of it depends on how large of a loan you have. So
Right.
I've had people that had really high loan amounts, 500,000, for example. And I know that's all relative, but that person could drop their interest rate 1/4 to 0.5% and make out well. A person with $150,000 loan, dropping your rate 1/4 to 0.5% may not have as much of an impact. And so everyone, I'm going to show everyone, here's how long it's going to take to break even on what the closing costs are versus how much you're saving every month. And then if it's within a reasonable period of time, say within a couple of years, you're going to be there longer than that, then that makes sense.
So it's an equation. It's an equation of putting the numbers in the proper lines, and then seeing what the bottom line is. And it may be that if you're going to save $20 or $30 a month on your mortgage payment, you may say, "Well, I'm not going to bother with it now." But if it's going to be a savings of $100 or a couple of $100 that, like you said, you can use to lower interest rate on some of your credit card debt, or other things. Maybe the kids are getting ready to go into school and need additional funding. Then freeing up an extra $100, $200 a month that's real money.
It is. It is.
How long does the process take? I come into you and I say, "Listen, John, I think I want to refinance my house, and I'm not sure whether to do it or whether not to do it, and all to pre-qualify me or approve me or whatever for a refi or even for a purchase." What's the length of the process?
So typically, if somebody's going to be buying a home, I can have them pre-approved within a couple of hours. And
Really?
they just have to get me their documentation. I'll review it and pull their credit. And if they need it that quickly, I can do it that quickly. And we typically close our loans 21 days is fairly comfortable on a purchase transaction. The market's taking a little bit longer now, mainly because the appraisal process is stretching out more, but certainly under 30 days on a purchase transaction. And most of my refinances I get done under 30 days as well. If somebody is more complicated, like self-employed borrowers are a little bit more complicated, those may take a little bit longer, but if it needs to be done quickly, I can get it done quickly. Whereas if you go to your bank, you might be in line for 90 to 120 days before they get around to it.
I'm reminded of the second home that my wife and I purchased, and this goes back a long time. This was in Illinois. We went to the bank to file all the paperwork, and I've always been in the habit, when I get a credit card statement and all, I take out my checkbook and I write a check and I send it in. We had one car that we owned and a second car that we were leasing and all. So that was one payment we had. We probably had 3 credit cards, which we paid off in full every month. Mm-hmm. So when we went in to apply for the loan, we sat there in the bank and we said, "Well, okay, the auto loan is this much per month." Okay, and what other debt do you have? What other credit cards? How much you can? Nothing. Boy, they looked at us cross-eyed, like we didn't have enough of a credit history for them to base the loan on, and it almost made us feel feel, bad because they couldn't get enough of a history on.
Yeah.
But today the process has become a little bit more streamlined. And does it work in the it works in the favor of the purchaser today?
Well, maybe not.
Okay.
You just jogged a memory for me. When I bought my first home, I had some credit on my credit report from another John Snell, and it was all credit. So I just, the bank officer, that was before I was in the mortgage business, just it helped me. So that was kind of interesting. But the way the kind of the credit process works, it's much more streamlined now than it was when you and I got our first mortgages, Stuart. But your credit score is golden. If you've got a good credit score, everything else will fall into place, and it makes it so much easier for you. And you could have a really good credit score with only a couple of trade lines. The lenders don't really, they just look at the score primarily, and after that, they kind of check off, okay, this is credit is good. And so that's really, in that way, the credit isn't as investigated or looked at as closely as it has been in the past, unless you have bad credit, and then your score is going to be low and you will not get approved with a low credit score. Whereas in the past, you could write some sad letters of explanation, my cat got run over, and that's why I missed the payment last month, and with something that would touch the underwriter's heart, they would forgive you for that. But now it's if your credit score isn't at a certain level, it ain't happening. So so it's a little bit different.
Well, let's say that my credit score isn't stellar. Maybe I had made some bad decisions early on in my life, and it caused some bad credit debt. But I've been working really hard over the last 10 years to build it up. But I'm still just at a mediocre level. Would that then affect that pre-qualification or pre-approval process? In other words, you might say, look, because of your credit, maybe you can afford a home for $200,000 instead of $250,000. It is. You mentioned that credit score is golden. If it's not golden, how does that really affect my ability to buy a house?
Well, if it meets a certain level, then you'll be okay. But below that level, no. So most of the loans I do are going to be above 680 credit scores. I've got most of the lenders I work with will go down to 620. There are a few lenders I work with that will go lower, but those loans are really hard to get approved. But so if you're at a 620, you can still get approved, but you will really get hurt by the interest rate that you're offered. So somebody with a 620 credit score is going to have a much higher rate than somebody with a 740 credit score. You still might be able to buy the house, but it's just not going to be at the same terms. And so part of what I do when I consult with somebody is if they're not able to get really good terms right now, then I put them on a plan. Here's 1, 2, 3, 4 things you need to do to put yourself in a position where your credit score will go up enough where now you may not get the very best rates, but you'll be much closer to that than getting the worst rates.
Well, and that's exactly the kind of thing that somebody needs to have you for, is to be able to say, like you said, all right, here's 3 or 4 things that you need to do in order to put yourself financially in a better position. Is mortgage lending something that you always wanted to do, or how did you get into it?
Well, I will tell you that I don't know of anybody that intentionally went into mortgage lending. So, and I certainly didn't. But I started off, my first career was in architecture, believe it or not, and went through architecture school, graduated, worked for a couple of years, and then I went back to grad school because I had to have a master's degree in architecture to practice. And at the same time, when I was in grad school, they offered a joint program with the business school. So I got my MBA at the same time. And what I found is, Stuart, that I kind of gravitated more towards the financial part, the business part, and real estate was really a way where I could combine the two disciplines. And so my intention was to become a developer who would hire the architects to do our projects. And when I ended up in Dallas with that intention, that was right before our collapse here in the mid to late 80s. And so that plan never got realized, but I did work for several years kind of doing cleanup work with the savings and loan mess. And if you were I don't know if you were in Dallas at that time, but it was bad. The savings and loan industry went down. Oil and gas went down. Insurance. It was bad back then. But after my very last job, where I was working for a bank, they said, "John, thank you very much. You've done a great job for us here, but we don't need you anymore." So so I was out dusting off my resume to look for a similar position, and a former colleague said, "Hey, John, why don't you come and help us do some refinances? The rates have dropped from 12 to 9, and we can't keep up with it." So I thought, well, while I'm looking for the next job, I'll do this to make a little bit of money, and I just kind of fell in love with it. The part that I enjoy about mortgage lending is, which I didn't have when I was in the commercial type world, is I know I'm making a difference in somebody's life. When even back then, if I could save them $100, $200 a month on a refinance, that was a car payment back then, and that could
Sure.
change somebody's life. And even today, helping people restructure their finances through a mortgage is something that I do. And so those warm fuzzies, where you're helping somebody, I never got that in the commercial real estate world. It was, kick you in the teeth and move on. So that was something that when I got into it, that was something I really enjoyed. And then I knew the numbers better than most other people that I was around, just from my background. So that combination just kind of set with me, and that was 28 years ago. So I've been doing it ever since. So I will say I never intended to be a mortgage lender, but it found me at the right time, and it's been a great career.
Well, and what you do well. And again, I encourage those that are watching the show and listening to the show, call on John. If you've got questions, go to the websites and all. He'll be there for you. He'll take care. If he can help, fine. If he can't help, he'll tell you that also. So, John, thank you very much for taking the time today to be on the show, to share your expertise with our audience, and the very best to you. I look forward to seeing you in our networking group as we go forward. And again, thanks for being on Someone You Should Know.
Well, thank you, Stuart. I appreciate you and the opportunity to chat with you this morning.
Very good. So that'll do it for another episode of Someone You Should Know. As I say, go out and be yourself, because everyone else is taken. Talk to you again next week for another episode. Bye.
Bye, guys.